you have this 15 by 15 by 15 matrix.
Very tough to implement. Tata Steel is existing for 100 years. Some of these new age companies might not exist beyond 5 years.
Are all high PE businesses in a sense at risk? Would you say that?
If there is no
Not
growth,
only the valuation risk, but also risk of competition coming and disrupting
that is there
businesses.
if they are not able to manage growth.
Will the market reward companies which actually dilute their return ratios in favor of growth in today's environment?
Companies are to blame, but the bigger blame should be to investors like us.
Right.
In 2020 and 21, we used to try and look at companies which can double in 3 years. And then 23, 24, we were looking at companies which can double in 4 years.
Right.
Now, even if it's 4.5, 5 years, we are fine.
What are the typical questions you ask a promoter?
Obviously, that zeal is slightly more. I'm not saying that executives don't work as much.
Right.
But it's like, having a shop and the owner is at the galla.
Right.
And there's a little bit more efficiency.
Right. Most of your successes from these perception changes. A lot of companies in your portfolio are bets on special situations in some sense.
Because of your view on perception change is not coming true.
You are buddies with Mukul Agarwal, and he's a very reticent investor.
Mukul is a great screen reader and a very, very perpetual kind of investor. Madhu is, I would say, the most passionate person I've ever met. You like to be with people. When you're together, it is smiles, not only, you're not talking about only work,
Of course. Hello and welcome to The Wealth Formula. Today, I have with me an OG fund manager who has spent more than 25 years in this business. He went out of the mutual fund industry to launch his own AIF, built a formidable track record for himself, both in the mutual fund as well as in his AIF, and now is back in the game with a license to launch a mutual fund. So no prizes for guessing who we have on the show today. Sunil Singhania, Abakkus Investment Managers. Sunil, thank you so much for joining me on The Wealth Formula.
Thanks for having me.
There are always multiple factors that determine where the market goes. You had the tariff, and there are, of course, a lot of other moving parts as well. What do you think this whole thing means for the economy? What do you think is not in the price yet?
No, I think we have to look at it from different perspective. One is very clearly the government's intent of simplifying things. So reducing the bands, I think that's clearly, all the, I would say the confusion which used to be there about this price, lower than this price, I think that gets sorted with this. Obviously, rate cut is more than welcome. On a gross basis, 1 lakh crore of infusion in terms of money in the hands of consumers, on top of what we had already had in terms of lower income tax, which was another 1 lakh crore. And with interest rate cuts, which we have already seen, maybe lower EMIs, I think all put together, it's like a 20,000 crore per month additional, liquidity in the hands of the consumers. And I think it was needed because of all, as you said, the uncertainty going on. And I don't think this is going to be the end of it. Various ministers and the Prime Minister has clearly said that they will do everything to ensure that this growth rate of the economy of the target of 7%, they are very, very determined to do everything to help achieve that target. So I think very, very positive. Obviously, markets have their own way of looking at it. It was already being built up since the Independence Day speech of the Honorable Prime Minister. So to some extent, it was already in the price, like in the sense that everyone expected it. Yeah.
Right. So what is it that is not discounted? So if you were to just look out 2 quarters from now, let's say till the end of this fiscal, what do you think will be the key triggers for markets to sort of gain some kind of direction?
So Mahalakshmi, if you go back 12, 14 months, ever since June, July, when the 24, when the general elections happened, we had a market which was roaring. We hit an all-time high of 26,000 as far as Nifty is concerned. And since then, on a 1-year basis, we have not made any returns, largely because of the higher base effect.
Right.
And second is so many things happened internally and globally. Because of elections, everything got pushed back. The budget was in July of last year. The various ministries got allocations in August and September. And as a result of which, economy slowed down significantly. If you remember last September, we grew only at 5%. Corporate profit growth was only 3%.
Correct.
And then slowly the economy is starting to get a bearing with December numbers being slightly better, March being slightly better, and June even slightly better. So GDP growth from 5% to 6% to 6.5%, and the bazooka of 7.8%, which we saw, which might not be sustainable, but it's a good sort of thing to be in. The other thing is the external factors have also been very volatile. Multiple small wars. Two between Israel and Iran. One last August, one this June. India and Pakistan. First time. Multiple small wars. But the world is much more peaceful now. I think the only issue has been this tariff thing, which continues to linger. And particularly for India, we all expected India to be the first one of the block in reaching an agreement.
Yeah.
Maybe at a 15% kind of a tariff. But came 25%. And just as we were digesting that, we got another 25%. So I think we have had multiple headwinds. Despite that, I think we have been resilient as an economy. I think on the policy front, the new RBI governor has already infused 8 lakh crores plus of liquidity. Another 2.5 lakh crores being infused now because the CRR cut gets into effect from September. 100 basis points of rate cut. As I mentioned earlier, a total of 2.5 lakh crores of stimulus by way of lower income tax, lower GST, and lower EMI because of lower interest rates. So I think things are building up pretty fine. Our view is that 80-85% of the headwinds are behind us. The only thing that 15% remaining is this tariff thing.
Right.
On the tariff front also, I don't think we are going to go beyond 50, right? So at the margin, it can be 40, 30, 20, depends on how egos and politics play rather than economic decisions.
Right.
And we are hopeful that it might be 1 week, it might be 2-3 months, but there will be some resolution. On the corporate profitability front, I think June was pretty okay, 9.5% overall corporate profit growth. September will optically look good because last September was very bad.
Right.
But December and March, we are very hopeful of a significant turnaround. Largely because of the whole impact of this stimulus, because of lower taxes and lower interest rates coming up, the 10 lakh crores of liquidity being infused, and generally a busy season. Monsoons have been good. Rural economies already started to pick up. Even before this GST cuts, tractor sales have been roaring at 20-25% growth. Tier 3, Tier 4 consumption is growing. Agrochemicals are growing. Monsoons have been good. So agri-produce will be good. And we are also heading into a busy season of festivals and marriage and all. So I think second half should surprise on low expectations.
Okay. Like you rightly pointed out, Sunil, there seems to be two sides of this argument. One side, like you were saying, everything's looking better. You had the tax cut, you had the GST cut now, you had the bazooka from the RBI, you have lower inflation. Nobody expected this level of inflation, right? That is on one side. On the other side, something that is totally unexpected, the job losses. And I'm also told even in finance, there are job losses. In lots of other sectors, there is some level of contraction because anybody who is talking about AI, any company without saying it was also, looking at least 10-15% job losses. So when you put these two things together, do you think on balance, we will have consumption demand pick up? You think that will be a good cushion?
First of all, I am not in the camp that we'll have job losses.
Okay.
Maybe, this is an aberration.
Okay.
And largely because so many things have happened, particularly sectors which are hit by tariff. I think there is problem. If this 50% tariff sustains, there is going to be a problem because a lot of the sectors hit are very labor intensive, whether it is garments, textiles, shoes, jewelry, and so on and so forth. And maybe some portion of the job losses is because of that also.
Right.
As far as AI is concerned, I have not heard companies looking at cutting jobs. At the margin, they will hire less number of people. Because for AI implementation also, you need people.
Right.
It's all about sentiments. I think the moment sentiments increase or improve, and which should now with all these things, I think you will start to see jobs also building up. As a company, we are going to hire 50-60% more.
Right.
So 150 will go to 225-250 people. So I think there are sectors which are growing also. We are not unduly worried about job losses, other than the fact that if this 50% tariff were to continue for a very, very long period of time, which is not the base case. I think that's a 2%, 5% probability. We should be pretty okay.
So you expect that clearly it will come down to at least 25%. It will not remain at 50%, right? tariff.
I don't think what has India done
Right,
to
to
be
deserve
worse
50%.
than China, which is at 30%.
Right.
And China is openly floating everything. But, it's posturing.
Right.
वो हिंदी में बोलते हैं ना, जो जिसको दबा सकते हैं उसको दबाओ. तो वैसा है, too
Right.
strong,
Right.
you can't, do anything.
Right.
But
right.
now there is a lot of flack which US is also getting. In fact, India already has an FTA with UK.
Yeah.
The German foreign minister is in India. It's all there in the news. They're talking about entering into a EU and India FTA ASAP. I think the world is also started to recognize that this whole tariff thing is not only about economics. It is much beyond economics.
Right.
And, it's a matter of time. Yeah.
Sure. Okay. So if you were to just map the market, where are you putting money now? Because of this consumption, you were one of the first ones to call out, bubble in quality. Most of the consumer stocks, the high quality private sector banks and all of that in
19,
early COVID,
yeah,
right?
yeah.
Like 2019, 2020, we're talking about it. Is that tide, you think, turning now?
So consumption will benefit. One is because obviously we believe that growth in the economy will be 6.5%, 7%. And secondly, obviously the near-term bump up because of GST price cuts. However, I think staples as a sector is still not cheap. So you might have that 5-10% move because people are a little bit shy of taking risks. So you wanted to get into safer stocks. And then you have this little bit of impetus coming from GST related news flow. But the growth there is a challenge. Largely, one, we are quite well penetrated compared to earlier. Second is inflation is low. So value-wise, growth is a challenge.
Right.
So earlier, Mahalakshmi, if GDP used to be 7%, inflation was 7%. So it was easy to grow at 14%, which was the nominal GDP growth rate. Now inflation is 2.5%.
Right.
So even at 7.8, the nominal GDP is like 10%.
Correct.
So that is also a challenge. The third is the advent of new brands. I think
Right.
if you be on any social media, the number of D2C brands, they keep on, taking away 0.5%, 1% market share. So we are not very enthused with the staples. But yes, discretionary consumption, including automobiles, which will have a great time, some discretionary consumption, that might turn to be interesting. The only problem is valuation.
Yeah.
And being a little stingy on valuation, that becomes a challenge for us. Yeah.
So autos, you see a good pickup. I mean, you think demand will start to look up much better because that is where anyway, ACs, TVs, all the white goods, all of that is seeing a large cut.
So autos, we are underweight, I'll be very honest. But I think with this GST cut, that is one sector which benefits the most.
Correct.
Because it's a high value purchase.
Right.
And a 10% cut is significant. On top of it, if interest rates get passed on, which so far, at least on the auto side, has not been passed on, but it get passed on, you might have another 2-3% benefit coming from that. And on the rural side, our view is more positive a little earlier. Maybe urban will also catch up, but that also should help. So I think you will see a decent growth in the festive season. So from 22nd September, where the new GST rules set in, it also coincides with Navratri, which is a festive season.
Right.
I think between September and November, you will start to see huge numbers. And maybe, what we are talking about in terms of GST collections being lower, that to some extent might get compensated by higher volumes.
That is what seems to be the government's bet also. But tell me, so you're still underweight consumer staples, you're still underweight autos. So what is the segment that you're
So auto, we are playing through some ancillaries. So,
Okay.
as a sector, we are okay. It's not that we are overweight on these auto companies. We have in some funds, particularly the largest tractor manufacturer, which is also a big PV players. I think financials of all kinds, whether fund-based or non-fund-based, we are positive, particularly our own business, wealth and asset management business. I think there's a long way to go there. I think pharma, we are positive. And there might be a near-term headwind because if Trump wakes up and says, now I'm going to put tariff on pharma also,
Right.
there might be a sentimental impact. I don't think generics will get impacted that much. But then smaller sectors, I think metals, we are quite positive. Chemicals, we are quite positive. There are some good engineering companies because of a little bit of, I would say correction in the market, as well as, focus on exports, and therefore tariff hits them. They're getting interesting. So that is again some place where we see incremental interest. IT services, I think there is going to be a shift from IT services to new age companies. And new age companies normally we were avoiding, but some of these companies have started to turn profitable.
Right.
So then they start to come into our horizon because we only invest in profitable companies. But I think there will be some shift of fund allocation from the traditional IT companies to the new age IT companies.
Right. One of the allegations about against a lot of, very good companies, blue chip companies in India is that everybody is very fixated on the ROC, very high return ratios, whether you see IT companies or consumer companies. The allegation seems to be that they are too stingy with respect to spending. So they don't want to cut down their margins, or the IT, they don't spend enough on R&D. So that is one of the things that is becoming a problem in terms of, growth sustainability. What do you think? What is your view on what is it that companies are doing wrong, if you think so? And will the market reward companies which actually dilute their return ratios in favor of growth in today's environment?
So I would say the companies are to blame, but the bigger blame should be to investors like us.
Right. Yeah, you particularly, because you're so particular about return ratios.
I think all of us are.
Several others.
So, see, we have to also look at the history of our evolution.
Right.
We are a new economy, and investment is again not 300, 400 year old, Equity investing has only picked up last 30, 40 years.
Right.
So we are by nature little bit traditional, and therefore we want to take less risks.
Right.
And I think that is what has got imbibed in the entire ecosystem, and that is what we keep on pushing the companies also. I think one reason, obviously, why, say, IT services companies in India have not been, I would say, innovators, have been because they have also been too fixated on profitability.
Right.
So, the likes of all the Infosys and Wipro and TCS and HCL and so many other companies, they have just kept on hoarding cash and deploying it at 5%, 6% returns, or just doing buybacks and giving it to their shareholders. I think somewhere down the line, if some of these companies would have taken a call of investing in AI long back or some other things, or even pharma companies, pharma companies get punished when they spend too much on R&D. And we have seen so many companies like Dr. Reddy's and Sun Pharma and all, either they've shut their R&D division or they got it listed separately.
Correct.
So I think it has been a phase where we evolved, where, the near-term profitability, return ratios were more important to the company as well as the investors. But I think now slowly the realization is coming, and that's why you are seeing the new age companies getting listed without profits or without too much of profits. And they are there to invest because they have a very different mindset. So I think it's an evolution. It will evolve. But you are right. I think the traditional companies have been a little bit more conservative. Maybe it is time for them to start being a little bit more, I would say, forward-looking.
So for these two, especially consumer and IT, do you think companies which start to spend a lot more, let's say HUL starts to spend a lot more on acquisitions, will that be seen as a positive? Will stock markets really reward decisions like that?
See, I don't know acquisitions or what, that the management has to take a call. But ultimately, as a forward-looking organization, are you going to be happy with the 2% growth all your life?
Right.
In an economy which is growing real terms 6.5%, 7%, and nominal terms 10%, 11%. So I think the management themselves will introspect, and they will also come out with strategies where they can at least grow in line with the nominal GDP growth rate of the economy. Now, whether it is through acquisitions or whether it is through expanding their product portfolio or going into new age businesses, which are obviously going to add or grow faster, I think time will tell, but they will have to. Otherwise, the value of the shareholders will keep on getting lower and lower.
Fair enough. So, Sunil, you have this 15 by 15 by 15 matrix.
Very tough to implement.
So 15% growth, 15
ROC
P and 15 ROC, right? So in that 15 by 15 by 15, how is the playing field looking right now? I mean, how many stocks do you think, let's say, out of the universe will even make that cutoff?
So one is we look at it at the portfolio level. So, we have the MEETS framework where S is structural. So we do take some structural bets, which might be slightly expensive. But at the portfolio level, we still try to ensure that our PE is lower than the benchmark, our growth rates are higher than the benchmark, and ROC, RO is sacrosanct, 14, 15%. But having said that, I mentioned to you, like say in pharma, wealth has been made, but bigger wealth has been made in ancillary healthcare, which is like hospitals,
right,
diagnostic chains. So last 10 years, if you moved a little bit from traditional pharma into these, you would have made higher returns. I think in IT, also the same thing might happen.
Right.
So right now, most of the money of investors is in IT services. That has to move to ancillary thing. And there, it will be slightly more expensive. So I think as a forward-looking investment professional, we are also thinking whether we can have 5-10% of our portfolio which follows discipline as far as capital allocation is concerned, which follows the profit thing, because that is very important. But we give a little bit of a leeway in terms of valuation. Because some of these companies which are growing at 70-80%, you are not going to be able to get at 15p. But still at the portfolio level, we try to see if we can be closer to what is the sort of stated policy.
Right. So this valuation, higher valuation you're saying is strictly because of the nature of business, you think because they will be high growth and they have a longer trajectory, or because the general valuation in India is now, reset at a higher level, maybe because of flows?
So general valuation has moved up,
right,
but still at the portfolio level, you are able to maintain that because, if you are able to buy financials at 8p, 10p, 12p,
right,
you're able to balance it. But the new age businesses, see, valuation is a function of growth also. So we are willing to give a 50p for a company which is growing at 30-40%. You can't give a 70p for a company which is growing at 5%. So that is what we try to distinguish. So at the portfolio level, I think you will have to have some of these businesses which we still have very low percentage, but as I said, as a forward thinking investment professional, we just have to keep on introspecting.
Okay, so let me get this right. For example, a company like Zomato or a Nykaa or Paytm for that matter, where they will not fit into a 40 times PE also or a 50 times PE also. So how do you look at them? I mean, can you build a portfolio which has very high multiples in anticipation of very strong growth in the next 3 years, balance it with, some others, or on each stock you need to take a call on?
So 2-3 things. One is it is a very difficult decision for an investor like me, who is a little bit valuation focused. But as I said, we have to evolve. Second is whether we'll have 30-40% of the portfolio in these stocks. I don't think so.
Right.
Third thing is a lot of these companies earlier were only in the burning mode. I think now all of them are focused on profitability, and they've turned also. Quite a few have turned profitable also.
Right.
Fourth is the growth rate is phenomenal. So unit economics is positive, growth rate is phenomenal. So the percentage growth in profitability will be multiples.
Right.
It will be 400-500% because on a low base.
Right.
So on a forward basis, if you just forward it to 28 or 29, these companies also, quite a few of them start to look at like 40p, 30p, 35p with 100% growth.
Right.
So I think somewhere you'll have to basically say that, okay, India is not only the traditional companies. India is also 5%, 7% these new age companies. Can we have within our parameters of at least ensuring decent respect as far as capital allocation is concerned, look at some of them.
It is a reality that competition in that segment is also really heating up.
Yeah.
So how do you marry these two? Because you don't know where the ball is going to be 2 years down the line.
That's why we don't have it in the portfolio. It's very confusing. And you are right. See, competition is coming up. Earlier, competition used to come up to take a share of the profit pie.
Right.
So if there is a business which is generating, say, 10,000 crores of profit, so competition used to come up that out of this 10,000, can I take 500,000?
Right.
Now competition is coming up to take a share of the market cap.
Correct,
which is more dangerous.
Correct.
So there are a lot of entrepreneurs who come in not to make profits, but because they see the huge market cap.
Right.
So if Zomato is at 3 lakh crore and Swiggy, I don't know, is at 2 lakh crore, then there might be something else which might come up and say, at least we can make $1 billion, $2 billion. I think that is dangerous.
Right.
That is dangerous for the existing companies. And that is dangerous for the investors in the new companies because, in these businesses, the top two will take 80-90% market share.
Very interesting point you're saying. So is that something that is coming up in your interactions with promoters, or you're just looking at the actions and saying?
No, you can see it in paints.
Yeah.
I think you see the market cap of the leader and you have 5-6 other companies coming up. Maybe, they will make a lot of profit over the next 5-10 years. But in the near term, I think the motivation is, the market cap, because profit pool is not very large.
Right.
All paint companies put together make 6,000-7,000 crores of profit.
So are all high PE businesses, in a sense, at risk? Would you say that?
If there is no
Not
growth,
only the valuation risk, but also risk of competition coming and disrupting
that is there
businesses.
if they are not able to manage growth. See, competition is not easy in everything. At the same time, as you mentioned the name of some consumer companies, if they don't evolve, tastes are changing, and we as human beings, and particularly the younger guys, are open to experimentation. We are not fixated that we want to wear only those shoes. Earlier there were 2-3 brands. Now we are open. Clothes also we are very open.
Correct.
Personal care, whether it is makeup or cream or something, we are all open to it. So, the existing market leader will have to work that much harder to protect their fort.
Fair enough. How alarmed are you with this trend of, promoters actually coming out and selling equities? It just seems like it's unrelenting. It's a trend that keeps on, it keeps surprising.
It's opportunistic, and it is also a signal that they themselves believe that
the peak valuation
the valuations are high. So, I think it is obviously, in many cases, opportunistic. Maybe in some cases there is a genuine reason. But I would say if one thing which is a little bit bothering as far as markets are concerned is this huge supply.
Yeah.
Out of promoter selling, PE selling, existing companies raising more capital, or companies coming out with IPOs. No one wants to, or very few companies want to go and borrow money to set up projects because equity is available at very good valuations very easily. And I think that is one reason why markets are taking time to get into that upward trajectory.
So do you see this as a signal, Sunil, at all, that a promoter selling, will you avoid the stock? Do you look at that level as an important resistance level from a stock perspective?
Logically, you will. But it also gives an opportunity for large investors
to put
in sizable sums of money to work. And that's why if you see, if the good company comes out, there are more than enough investors because, without impact cost, you are able to invest in companies. So it works both the ways. Yeah.
What about other areas of hyper growth? You have, I think, in one of your presentations, you talked about, renewables, wealth creation companies, EV companies, all of these in the hyper growth category. First of all, defense, all of these. Where do they figure in your scheme of things at today's market valuations?
So asset and wealth management, definitely good. I would not say hyper growth, but 20-25% growth still possible. Half of it because of appreciation and half of it because of new money coming in. I think it's a good sector. It will have its ups and downs depending on how the market perform, because in the double engine, one engine is appreciation because of price movement. Other sectors, renewable, I think there are definitely opportunities in the renewable sector, but a lot of companies are coming up. So I don't know on the equity side how to value them. But from an economy perspective and from a corporate India perspective, I think that is one of the best things to happen for us. I think energy costs in India have always been high because we are dependent on global energy sources. And now with this whole renewable boom, and Reliance has talked about 550,000 acres in one location. Adani is doing a lot of things. Tata is doing, a lot of other companies, the larger ones like JSW, Torrent, all have plans, and there are multiple small and medium-sized companies doing it. Our target of 2030 has been met in 2025 itself. So I think renewable as I would say, you can call it a product, along with battery storage, can be a big driver for efficiency in India coming up. And I think that is somewhere you don't only have to see the companies which are directly involved in this, but also the beneficiaries of it. Defense will be a big theme, but frankly, I don't know how to play it because I think defense is now very different from earlier. We are not going to go into wars with swords and cannons and guns. It is all in the air.
Right.
So defense also one has to be a little bit particular about what kind of defense, and stocks are not very cheap. But I think the good thing is India has a lot going for it. Young population, so consumption will be there. Focus of the government of Make in India, I think that becomes more pronounced with all these tariff things coming up. And, the evolution of the economy. So it's not the only traditional economy, It's evolving. And I think that is also where opportunities will also come in. So it's fine, Stocks are not as cheap. So you can't expect.
But I don't see any of these in your portfolio. I don't
we
see
have bits and
defense.
pieces. We have bits and pieces. We have some defense companies.
Dynamatic technologies.
Where we have some comfort. We have asset and wealth management companies. On the renewable side, as I said, on the equipment side, we are a little bit wary because so many companies are coming up with cell manufacturing facilities and module manufacturing facilities. Maybe for the next 2 years, profit will be good. But I don't know how to value them because after 2 years, there's going to be a glut of there.
Correct. So equipment manufacturers, would you avoid because you don't know how after the peak cycle,
unless there is a clear
moat
in terms of the last man standing and valuations are in your favor.
Also, one of the things I noticed in your portfolios, you have, I think, IIFL Securities, you have Edelweiss, etc., but you don't have any banks. Any particular reason?
We have a lot of banks. Okay. We have a lot of banks. Obviously in banks, we prefer larger banks, but we have some mid-sized banks also.
You have?
Yeah.
Okay.
But banks will grow slower than the trend line. I think 10-12% is what the larger banks can grow. And maybe, 13-14% is what you can make of them because generally low inflation means low nominal GDP growth rate.
Correct.
And that's why the credit growth also to that extent will be lower. Yeah.
Sure. Now we'll delve a little into your approach and philosophy. One of the things that you say is your key tenet of investing is that there is no investment rule. That investment law is that there is no investment rule. And you bust all the popular narratives. Can you take us through, the popular narratives and your logic of why it doesn't hold good?
So one is, Mahalakshmi, see, every investor will have different perspectives, different way of investing, different things which have worked, different things which have not worked.
Correct.
And out of your experience, you keep on fine-tuning, and then you come to a situation where, you do pretty much the same thing in every investment you make, So I think we have also created a rule. We call it the MEETS framework. It's very, very well known. I think M is management. Obviously, we all want good management. But for us, discipline in terms of capital deployment becomes very important. So typically 14-15% ROC is at the minimum what we see.
Right.
Equity is a growing asset class. So you want to invest in companies which are growing. So the E is, in the MEETS framework, earnings which can double in 4 to 5 years. The second E is event trends and disruptions. We are in a disruptive world. We can't buy anything for 20, 30 years and forget about it.
Right.
Companies might not exist. Newspapers, for example, they exist, but the ad revenue is going down because it's moving to the digital platform.
Right.
Even entertainment, the earlier Star and Sony and all, they still exist, but incremental entertainment is moving to the Netflix and the Amazon Prime and the OTTs of the world. Even cars globally, I think EVs have really, really grown faster. And that's why Tesla and BYD have been wealth creators, but BMW and Mercedes and Stellantis and Volkswagen, they trade at 6-7p. So I think you have to be aware of that. T is the timing which we discussed earlier, that you can't buy anything at any value.
Right.
So the best company is not the best stock. Yeah. And last is a structural bit. Despite all this conservativeness, there will be some stocks where we'll have to remove our conservative hat and see whether these companies can grow 30, 40, 50% or much faster than the ecosystem, general corporate ecosystem. And there you will have to get a premium. So I think everything falls within this place. What we say is that, we are not in the camp, we'll say that we'll not buy metals or we'll not buy investment in the sense that huge capex companies. We are okay.
Right.
As long as the debt to EBITDA and the ROC are met. Because if no companies invest, then how will the country grow?
Yeah.
If everyone just sells toothpaste and soaps and clothes, then this GDP of 7% is not going to come. You need companies to set up power plants, to set up steel plants, and to set up auto plants and cement plants and all. But there has to be discipline in terms of return on capital employed.
I still remember the statement you made, which is totally etched in my memory. You said that companies which can absorb a lot of capital also give you the opportunity to deploy a lot of capital.
Definitely. And, see, ultimately, what is investing, or what is, I would say, generally corporates. You have different segments. Obviously, in some segments, the requirement of initial capital is higher.
Right.
Therefore, the entry barrier is that itself. You're not going to have 20 steel companies coming up, or 20 auto companies coming up. But it is also a business which takes time to start giving you returns. But then when it starts, it's a perpetual. Tata Steel is existing for 100 years. Some of these new age companies might not exist beyond 5 years.
Correct.
So I think you have to marry the two.
True. So you were talking about the meets framework.
Yeah.
So everything falls under that.
Yeah. So everything falls under that. But as I said, as a forward-looking professional, see, if you don't evolve, you will be outdated. So at some point of time, a test player also has to start to score a little bit quickly when the ODI is on, and more quickly when the T20 is on.
Yeah.
I'm not saying that we'll completely transform, but we have to keep on thinking that, see, the economy is changing. Now, if you see your and my spending, 20 years back, what were we spending on, and now what we are spending on? It's changed dramatically.
Right.
Dramatic change.
Right.
Yeah. So I think that is what the economy is. The economy is also changing same way. So there, little bit of exceptions will have to start to build in, but within the framework which we have created with discipline in terms of capital employed, and at least paying a price which is justifying, or the growth which is justifying the price you're paying.
One of the things that you have done very remarkably well is, hunting in this mid-cap space, where lots of companies, you've taken sizable bets in some of those companies which have done remarkably well, held on to them also for a fairly long time. So what is your framework for investing in, you say, look at under-researched companies where perception of the majority share, investors is negative. Yeah. Tell us that framework. What is your method to, pick the right candidates which are under-researched, the mid-cap hidden gems, as you call it?
So one is the basics of investing is the same.
Right.
In larger companies, they are evolved and they are discovered in the sense that everyone knows about everything, and the companies are also evolved. They will always grow at a particular pace. They might grow 2% more than the sector or 2% less. And everyone knows everything about the company. So obviously there you have to take a call on the sector and a little bit on when to buy, when not to buy. And you can make a little bit of alpha. In the broader markets, the awareness is less because in India you have so many companies. You don't have all the companies being covered by analysts. And there is also a little bit of in-house research and, I would say a more detailed work which you can do in those companies. Now, how do you make disproportionate returns?
Yeah.
So market price is equal to EPS into P.
Right.
EPS is earning, P is perception. So where both can improve, there is a multiple. So if profits double and the P also double, you have a 4-bagger. And that can only be possible where you still don't have that high perception because it's not discovered, or there is some, thing which is a question mark. So I think from our perspective, obviously it is not as easy to pick up stocks as it was earlier because so many now investors are doing what we used to do earlier. But you still end up meeting companies, who have a way of thinking. But the basic characteristics of ROC growth continues. I think the only thing is in some of these smaller companies, you are able to get a higher growth and lower P because they are undiscovered. But it's becoming more and more a challenge. So I always say that in 2020 and 21, we used to try and look at companies which can double in 3 years. And then 23, 24, we were looking at companies which can double in 4 years.
Right.
Now, even if it's 4.5, 5 years, we are fine. So
Right.
that's 14 to 16% return, we are fine. Because one, companies are discovered. And second is we are not as cheap generally as we used to be earlier.
Right. So tell me, in larger companies, this valuation discipline and looking at P and E is relatively easy. It's never easy at all because you have a long history, right? You can look at regression to mean, you can look at past cycles, etc. In mid-cap companies, it's a lot more difficult because the history may be smaller. The company itself may have transitioned. Maybe it's the next generation of entrepreneurs who've come in, whatever it is. So there there is a lot more predictive element in both the price earnings as well as the earnings. How do you do that? What gives you the confidence?
So earlier, I think the general rule was you buy something at a market cap where hopefully in the next 8-10 years, that would be the profit.
Yeah. Yeah.
So that was one thing, that the profit should at some point of time reach your entry market cap.
Right.
That will only be possible when the potential of the business is huge. The company is doing all the right things to make good the potential.
Right.
And obviously you need, I would say, a very passionate promoter. See, in smaller companies, you have the owner who is the management.
Right.
So obviously that zeal is slightly more. I'm not saying that executives don't work as much.
Right.
But it's like, having a shop and the owner is at the galla.
Right.
And there's a little bit more efficiency.
Right. Right.
So that is there. I think in mid and small cap, one thing you have to basically be very clear of, that the volatility will be very high. Like in January, February 25, what we saw, the large caps did not fall as much. The mid and small cap fell more. One, they had risen more. And second is when the risk off happens, the smaller companies tend to fall a bit more. So you have to be aware of that. And maybe if you are patient, those are the opportunities where you have already shortlisted a few companies you can invest in. Third thing is you'll have to size your position a little bit. You can't have a 10% of your portfolio in real small companies because one, there is liquidity risk, and second is if something goes wrong, then the whole portfolio will take a beating.
Right.
So I think you'll also have to adjust your portfolio decisions. So in large cap, you might be okay with a 20-25 stock portfolio.
Right.
But in an absolute small cap, maybe it will be more like 35-40. Some funds have 150, but that's too long. But a tail. But I think little bit by experience, you keep on doing it. But I'll be very honest. I think the quality of investors and research analysts have improved dramatically. And that is obviously going to make the markets more and more efficient.
Right.
But I think the hope is that we'll be able to find something which will allow us to make a little bit of alpha. And that's how we are surviving.
Right. True. Tell me, so again, back to the same question on how do you evaluate this? Is it the quality of the promoter? In which case, how do you assess it? Is it that you need to be convinced, or is it some kind of gut feel that you develop for a person or the promoter because he's the person who's going to drive everything, right? So
the advantage which we have is one, a long history. And at least other than the newly listed companies, we have a history of companies and promoters of how they have behaved in different cycles.
Right.
How they have behaved when the going is good, how they have behaved when the going is bad. So that helps, actually.
Right.
It's a small thing, but it helps. The other thing, obviously, is you have to have all the ingredients in place in terms of sector, in terms of the promoter, and in terms of the size of opportunity. But I think multi-baggers are made when there is a difference of perception. Perception of what the market thinks and perception of what you think. And if you see so many groups have created so much wealth when the perceptions change.
Right.
So many. You take example of JSW, even Adani, Murugappa. It was supposed to be a very sleepy kind of a group, and see how wealth has been created, and multiple others. So I think there, if you are right in judging that, the market is not giving the true credit to what can happen in the future. I think that is where you can have.
But how do you assess that? Up karte kaise ho? I mean, some of these
You have
cases,
to
how do
continuously
you sort of-
keep on meeting companies, being in touch. Balance sheets are very, very important because, in the director's report, in the management report, a lot of things get done. I'm a number person. Cash flows. A lot of companies, the first sign of turnaround is when the cash flows start to become much better. So I think it's a multiple of things. You mentioned about young guys coming in. A lot of places, the young guy has been a real rock star compared to the existing promoter. So that is there. Many places, professionals have changed. And the professional coming in has been phenomenal. We have an auto ancillary company where we own a big stake. It's done very well for us.
Right.
I think the new MD who came in 3-4 years back, from 13-14% margin, the company is making 21% margin. ROC is like 20-25%. I think people do make a difference.
So give me a list of, do you have a checklist or questions? If you're sitting
Actually,
with
I had done a session with CFA and even at Flame.
Right.
Of how to identify multi-baggers.
Right.
So there are multiple things. As I said, promoter change, management change. There are companies where there are two businesses. One might not be doing well, one is doing well.
A spin-off.
But as promoter, you always have a little bit of soft corner. But now they are open. They get rid of something which is not doing well and the business comes into being.
Right.
There's a foray into some different business which can be fantastic. So I think there are 7, 8, 9 key things, but you'll always add or remove some of them over a period of time.
Right. No, I was about to ask you, what are the typical questions you ask a promoter? For example, if we were to think about the perception problem in PSUs, for example, in 2020, a lot of people said we will never invest in PSU banks. But you could see in the numbers that, the cycle was going down. It was really cheap. Even the write-offs will go away means that the profits will start to kick in, right? That was a much easier call. But a change in management is really placing faith in what the promoter is saying. Let's say if it's Adani or a Murugappa Group or, anybody
but you
who
start
is in
to see in the numbers, right? So it's not only talk. You start to see in the numbers. Only talk will get you only up to a particular point. Then it is about delivery. And you mentioned about PSUs, so in 2019, instead of that time, the fancied banks like HDFC and Kotak, we went into ICICI and SBI.
Right.
ICICI had its own problem, but all the other tenets were in place.
Right.
And SBI was trading at like sub-book and so on and so forth. And, I think the general view, obviously all the reasons which you mentioned, lower NPA and so on and so forth. But if you logically look at it, SBI cards trades at private sector valuations. SBI AMC will trade at private sector valuations. SBI Life is to trade at private sector valuations.
Right.
So why would SBI trade at a significant discount to these valuations?
Right.
It's the same DNA, same brand.
Right.
So I think sometimes you have to take a call. It might work, it might not work. I think you're not going to be 100% right. But if you're okay that out of 10, even if you're right 6 or 7 times, you will be a superstar investor.
So, can you recall a few anecdotes of some of these companies or unusual things that you figured out? Perception changes or any
पहले तो बहुत होता
experiences?
था, अभी बहुत कम होता है.
चलो पहले का ही बता दो.
But see, even now, now there is a private sector bank, which has grown well. It's been a very decent bank, but investors are not very happy with the growth.
Right.
So the earlier CEO was phenomenal, cleaned the bank, grew up to a particular level, but not very aggressive in growth. Now they have taken a CEO from one of the other banks. And now if this growth from 11-12% goes to 14-15%, instead of 1.1, 1.2 time book, it can easily be 1.5, 1.6 time book. So I think, you know the mindset of the new guy who's coming in. Now you have to track, So I think that is one thing. I mentioned to you about these auto ancillary companies. I think very clearly numbers kept on coming. We have recently invested in a broking conglomerate,
Right.
which has been reeling because of a recent past thing. Now we've taken a leap of faith that at least, all the underlying businesses are sound. Now there is still a little bit of issue on the corporate side, but that is the reason we are getting it so cheap.
Right.
If there were no issues, then
You will not get it cheap.
So, you say, okay, it's a slightly higher risk. So can we buy 2% in our portfolio rather than buying 5? And when we get comfortable, we'll buy. We have a IT product company in our portfolio. Same thing, not growing, but we were tracking. There was a reason why the growth was slow. And the moment growth came in, the stock tripled. So, there are, I don't know how to put it, but different companies will have a very different, reason behind it.
So are most of your successes from these perception changes? A lot of companies in your portfolio are bets on special situations in some sense.
Because your view on perception change is not coming true, or perception changing the reverse side.
Has it happened?
Multiple times, I don't think we are God that will never go wrong. As I said, out of 10, if you go right 6 or 7, but the only good thing about having that framework is that our mistakes don't make us lose our shirt and pant. We'll never lose 100%.
Right.
Because we don't invest in loss-making companies, the ROCRO is in place. We might go down, or we might not perform, or we might perform slightly lower than the market.
Right.
But because of this framework, we'll never lose 100% of our capital. I think that is the maturity and the discipline which this framework brings in.
Right. Tell me about your, one of the things that you had said in your Flames presentation is, that you should act decisively and you should have strong opinions. And you talked about courage. So, courage is something, every decision is proven right or wrong only in hindsight, right? Like it's something that could have been will be seen as courageous, will also be seen as stupid if it went wrong. Right. So how do you do this? Even based on what you said, is it that you buy a small portion? Because I don't see you buying small. I always see you buying a reasonable stake even to begin with. So it's a bet. So how do you get that conviction?
So
what is your
frankly, I'm a conservative investor. In fact, if you ask me what should have changed in the last 10, 15 years, I would say I should have taken more bolder bets.
Okay.
Apart from what I've already done, so I'm a little bit conservative in that sense. We end up losing also a few opportunities, but which is fine. I think it is working fine. You see decisive bets, but if you see as a percentage of our portfolio, they are not like very large. The only thing is, obviously everyone wants to glorify things happening.
Right.
So even a 50, 60 crore buy is covered very extensively, but in a 40,000 crore portfolio, if you buy 100 crores, it's not like we have bought 10% of our money to work.
True.
But that is fine. I think everyone wants to be updated, and you need talking points and all. Right. But yes, when we are convinced, we buy because we know that the moment we buy, there will be others who would also start to look at it. And if you don't buy properly, then we will only be buying higher our own discovered stocks later, True. So you have to also manage that.
True. Can you recount some of your mistakes and what have they taught you?
What mistakes? So mistakes are of multiple kinds. You buy something and it's been a disaster. Luckily, we don't have disasters per se in the recent past. But yes, for regulatory reasons, we have had an NBFC where there was a ban on lending.
Right.
There was an income tax thing. And I don't think it was anything which was 100% because of the thing. But you end up having that drawdown. We still own the company because fundamentally we are okay. So I think you can say that was something which was not thing. We had an exposure to an EPC company who had sold a big portion of their portfolio, boot portfolio, but the money took 2 years to come. So that was a mistake in the sense that we thought that abhi deal hua hai, 3-6 mahine mein paisa aa jayega, wo aaya hi nahi paisa 2 saal tak. So for 2 years, the company ended up having a debt of another 1,000-1,500 crores, and therefore, so basically mistakes, one is you're a little hesitant to buy and you miss the bus.
Right.
Because you want to be sure. See, in investing, you'll always have to take that little bit of bet, right? If you are 100% sure, then the stock will not be at the price where it is.
Correct.
So I think that needs to change. And second is at least in my earlier avatar, there have been a few instances which I have publicly said. Bajaj Finance, for example, we sold early.
Right.
We bought Bajaj Finance 8-9% between market cap of 500 crores to 1,500
Right,
crores.
right.
But that time, 2008-9, money making was so difficult. The moment it doubled, we thought that we were
Yeah.
God's gift to mankind or investing world, and we sold. So many times, selling early is also a thing, but it's fine. It's you have to learn. I don't think you have to be harsh on yourself. कि ये क्या कर दिया?
Yeah.
You have to learn. You're not going to be 100% right on everything, but you just have to ensure that you at least introspect
Right.
what you could have done a little differently.
Right. Sunil, I'm presuming you manage all your money yourself, or have you also given it to other
My personal
managers?
money.
Your personal wealth.
So my personal wealth, I don't invest in stocks directly now. Very, very sporadically, some very small companies or some private companies. Otherwise, it's all in the fund. And frankly, I take very less salary. So whatever wealth is being created in the
fund.
in the company itself.
Right, right. No, my objective was to ask you, whom do you look up to as fund managers, and
many.
who are some of the?
So I think we are blessed because not too many people have survived 25-30 years of investing, and all of them.
Right.
So it's a mutual admiration, mutual respect, and very good people. They are all of them are among the richest. But humility is still what it used to be 20-25 years back, and I think that is why you gel with so many people. So I think you learn different things from different guys. Some are street smart, some are aggressive, some are good at taking calls, some are good at just buying and holding on forever. And I think everyone has a different perspective. I think I would say to the young budding professionals that learn from people, but don't blindly copy.
Yeah.
Because everyone's temperament is very different.
Right.
If I try to do what other is doing, the temperament be different. Many times, people buy what we have bought blindly. Now, our buying might be for a particular reason. It might be 1% of our fund. They end up buying 5-10% of the net worth. If it doesn't work, it is fine. It's a part of a portfolio.
Right.
So that also is something. So in our not to do, one thing is copy and mimic. Don't copy and mimic.
Right, right.
So I think that is something. But I'm blessed. I think very, very good friends. And
Tell me, you are buddies with Mukul Agarwal, and he's a very reticent investor. Doesn't do any media. I've also spoken to him about the podcast. He's not done it so far. Tell me his way of thinking. Something that you would.
Frankly, he's a very dear friend and a great individual and a great investor. And I would like to retain his privacy because if he's decided not to speak, then I should not be doing it.
Just as a thinker and as an investor, what stands out to you?
I'll put it the other way around. So, I know a lot of people.
Right.
Nimish Bhai is a great individual.
Right.
Obviously, so many others are there. Two people I have spent a lot of time.
Right.
Mukul and Madhu.
Right.
Okay. Mukul, because we grew up together. We still meet even now. We are like really, really good pals, and we go to holidays together, cricket together, but very different individuals.
Correct.
Madhu, we have worked together, and I think the biggest virtue of us being together was Madhu is really quick, really street smart, and I was a little bit more slow and more fundamental oriented, and it works. But the good thing is that everyone respects everyone's way of working and everyone's view.
Right.
So it's not that if I like a particular stock, anyone else would just buy it blindly.
Right.
And vice versa.
Right.
And I think that is what it
Correct.
should be. But, obviously, we manage public money.
Yeah,
we have to be on the media. Those people will forget. Those who don't, they don't need to be.
Right.
And they should not be.
Right. No, what stands out in terms of thought process? Is there anything that you can tell us about Madhu and also about Mukul? For you, what stands out?
So,
as investors,
I
they've
have
been
never
super successful.
seen more passionate people than both. Okay, because it's also about your hunger. Mukul is a great screen reader and a very, very perpetual kind of investor. Madhu is, I would say, the most passionate person I've ever met, not
Right.
only in investing, but otherwise.
Right.
And I think the way he gets into something which he wants to do is like really, really, I
Yeah.
don't think it is replicable. Very honest energy. It is not just to show that, and I think it's fun, I think, see, you like to be with people when you're together. It is, smiles, not only,
Right.
you're not talking about
Of course.
only work,
Of course,
Yeah.
of course.
So I think it's great.
On that note, thank you so much, Sunil. Such a
pleasure.
pleasure talking to you. Thank you so
Thanks
much.
for having me.
That's all on the Wealth Formula this week. See you again next week.